And so I think the stock market, the NASDAQ can continue to run, gold will make new highs, rates probably down another few hundred basis points. And then it's very bullish for Bitcoin and Ethereum and some of the companies we invest in the digital asset world.
Will the stock markets continue to move higher and perhaps break new records? What about gold and interest rates? Discussing asset classes for 2024 and investment themes with us is our next guest, Dan Tapiero. He is the founder, CIO, and CEO of Tenti Holdings and One Roundtable Partners. Dan has had over 30 years of experience working in the investment industry, and he's here to share with us what he thinks is going to happen in the coming months and quarters. But first, word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and 1% trading fees, the lowest in the crypto IRA space. And it offers unique tax benefits as well. So if you're over 18 and you want to open a new account with cash or roll over an existing account, click on iTrust.capital/David in the link below to get started and learn more. Dan, welcome to the show. It's good to see you. I've been a fan of your work. So very excited and looking forward to talking macro and investments with you today.
David, my pleasure. Exciting to be here. Exciting.
You've had a storied career as an investor, spanning several decades. Why don't you tell the audience about some of the places you've worked and the experiences prior to what you're doing now?
Oh boy, that could take the whole show. So maybe we'll just do a quick run through. I mean, I really started my career in the early 90s working for Julian Robertson at Tiger. I was in the macro group there, so focused on bonds, currencies, emerging markets, commodities. It was really my first taste of the global financial markets, and I was a very young guy. And funnily enough, I was put on the front lines right away. It was during the ERM crisis. I don't know if you actually probably, I'm not sure if you were born or not, but it was during the ERM crisis in 92, 93, and all the currency pegs were getting broken. So it was a very exciting time. Some people call it sort of the heyday of macro. I then ended up moving on and working for Michael Steinhardt at Steinhardt Partners, who was a competitor at the time of George Soros's and Julian Robertson's, and then eventually made my way to working for Steve Cohen at SAC Capital in the late 90s, and was with him for about 10 years total, and ran macro there, ran my own portfolio there. Again, focusing mostly on macro, big structural macro changes in the world. Ended up leaving Steve to go work for Stan Druckenmiller at Duquesne. And Stan and I there focused actually quite a lot on agriculture. You know, global macro hedge funds tend to move. You know, you've got the greatest asymmetry and in the bet. And so for quite a few years, I was focused almost exclusively on agriculture. And we built at the time what was the largest from 06 to 13, the largest agricultural farmland REIT in the US. We ended up selling that, and I mentioned this, to CPP, the Canadian pension fund system. Since you're in Vancouver, I can see that massive skyline behind you.
I'm curious as to how investing strategies overall have changed over the last 25 to 30 years, given how bond yields have continuously gone down. Did that shift portfolio managers' kind of philosophy or focus when yields just continuously come down?
Yeah, well, it's a great question. I mean, all of the big fund managers who you know and have read about, Soros and Julian, et cetera, I mean, they really made a killing in the early 90s, pretty much throughout the 90s, being long 2-year notes, you know, leveraged. And, you know, when you buy a 2-year note in the market, you have to put down a very little small amount of margin, especially if you're an institutional player. And so in 1992, I guess 2-year notes were 8%, or was it 91, 92? They were 8%. And in 93, maybe it was 91, they were 8%. They went down to 3% in 1993. So 1993 was probably the single biggest year for many of those fund managers, the traditional hedge fund managers. You had a big backup in 94, but then the continued drop in interest rates also helped expand the multiple in the equity markets. And so, you know, you didn't really see an interest rate higher than you did in the early 90s. Briefly in 2000, things popped up with the NASDAQ move up. But, then yields pretty much relentlessly dropped for the most part, except for a pop up in 06, 07. They dropped into 08, and then they dropped for another 10 years. So I would say that, the move from, an 8% interest rate, which used to be normal 30 years ago, to what was negative real interest rates for many, many years post 08, yeah, that changed a lot about the environment and about how one invested, and the degree, the amount of liquidity that was unleashed out there. You have a lot of people sitting in a 2-year note at 8 or 10% versus 0 or -5 in real yield terms, or -3 or whatever it is. So, this correction that we've had recently in the interest rates from 0 to 5 in the last 18 months, probably the most, the biggest change to the macro landscape in quite a while. It's such a long period of time, and the investing styles and focal points for people change so many different times. The one big thing that I would say, as opposed to getting into too much minutia, is just that it used to be that there were only, especially in the 90s and early 2000s, only, I don't know, a handful of really large, aggressive investment funds out there. And now I feel like the space generally is very crowded. You have the proliferation of information and data. Anyone can have a Bloomberg now and look at prices, and information is dispersed quickly. And also you have computer and algorithmic trading. So the point behind that is just that I think the opportunity set in the old world, and I call that the TradFi traditional world, bond, stocks, commodities, emerging markets, currencies, does not compare to the opportunity set that exists in the digital world.
Direction of rates going forward. So
Yeah.
a lot of people are talking about, we're not talking about the Fed funds rate anymore, because the Fed has already signaled the end of rate hikes. But what about the 10-year? What about the longer end of the curve? Is that going to still keep going up, Dan? In other words, should we keep shorting bonds? Is that, the short trade of a
Well, if you
decade?
stayed short for the last 5 weeks, you might be out of business if you're leveraged.
Yeah.
No, I think the peak in rates happened. Inflation has been dropping all year in the US. I think, honestly, in my 30 years, this is sort of the worst policy bungle I've seen by the Federal Reserve. It was very clear earlier in the year that inflation had peaked. The CPI had peaked around 8% and had, continually has dropped down to a 3 handle. And despite that fact, they kept raising and raised quite aggressively. I would have thought probably 3.5% was appropriate on the Fed funds rate. They kept raising it to 5. I did not expect that. I think they've over-tightened pretty dramatically, and we are seeing the slowdown now. I mean, the ISM numbers have been below 50 for many, many months now. I think it's almost approaching a record. And generally that does signify recession. I don't want to talk about recession because for me, a recession, there's so many different ways that people describe it. The academic way is 2 negative quarters back to back of GDP, Q over Q annualized. I just think a significant slowdown is in the works, and I think the Fed will be reversing. The rate peak that we saw a few weeks ago, I think, was the rate peak for the cycle on 2 years and 10 years. And I suspect that next year we'll see Fed funds down, could be even below 4. I just think the 10-year is leading the Federal Reserve, as it always does.
Why do you think the Fed made major blunders? I'm paraphrasing what you said.
Yeah, because I think, when the Fed funds rate was 3.5 or 4, it was quite clear that inflation was headed down to a normal level. All the leading indicators, and you can go to my X or my Twitter account, DTapCap, and I usually like to publish something once a week or sometimes every day. I was pretty clear, and I gave you, I showed a lot of data, a lot of charts that showed that all the leading indicators starting even a year ago were flagging that inflation was going to drop significantly. Historically, okay, the Fed, part of their mantra has been policy works with a lag, always, and it's about 18 months. This is the only Fed that I can recall that has been responding to like monthly moves in the CPI or the payroll number. It's been pretty crazy. Usually the Fed has more confidence in their ability to forecast and therefore make policy based on, what they think the implication is for the market and the economy 18 months forward. This time, there was no such view. And so they kept raising rates, even as all the forward indicators suggested that they didn't need to.
You briefly mentioned working during the 90s when at a time when Soros shorted currencies. Well, the Black Wednesday event in which he broke the pound sterling in 92, could that event or something similar happen today? In other words, do you see another currency crisis looming somewhere in the world?
No. Why? Because those were pegs. There were fundamental, misvaluations. All of those kinds of bets, they've played out for the most part. You had the Asian crisis in 97, 98, that was kicked off by the Thai baht deval on July 4th that year, 97. That was another like huge macro mispricing. Those things generally aren't out there anymore. Maybe there's an emerging market currency, that might have a big rally or sell off, but I don't see it. Also, look, there's a lot of government intervention in markets now, whether it's the central banks in, managing currencies, or whether it's, central banks doing QE or QT. We didn't really have that in the 90s. It was really late 80s, 90s, really more of a free market situation. The markets really were free markets, sort of as exists today in the digital asset ecosystem. And so, I do think the dollar's entered a pretty significant bear phase. I think the peak for the dollar and the dollar bull market, happened this year, I think when euro popped down below 98. So I suspect we could get a good, 10 to 20% move lower in the dollar the next 18 months. But no, like big, I don't see any huge macro mispricings. There are macro ideas that aren't priced into the market, but that's different.
10-20% decrease in the dollar relative to other currencies. Are you then assuming, or is that implying that the other central banks around the world are not going to be as dovish as the Fed in cutting rates?
Yeah, I mean, they should be. I don't know what the Europeans are doing, but and the Brits too. But yeah, I think, also look, dollar yen got up to 150. I mean, that sort of is it for now. And but this isn't a terribly strong view, nor am I like that interested. I mean, I think, gold will see new highs. To me, it's all just very simply about liquidity coming back into the markets as the interest rates drop. It's not any, super complex view. It's just the fact that the Fed over tightened just means that they're going to have to go the other way. One thing that's interesting, I will say, is if you have viewers out there who are long gold, I know you have a lot of Canadian people who hold gold in their portfolio. It's pretty incredible what happened with gold this year. If you think about the Fed interest rate going from 0 to 5%, if you had told me that gold was going to trade 2,000, despite the fact that short rates went up 5%, I would have said, no way, absolutely no chance. There's something underneath gold, something underlying it, and it's just fundamental strength. When you see a market trade that strong in the face of fundamentals that are counter to what would normally support it, it tells you that there's something going on. It might be, I don't know, in this case, maybe it's central bank buying, maybe it's buying from countries that are concerned about having too much of their assets in the dollar, after the US confiscated Russian reserves that were held in dollars. maybe some of these emerging countries, second-tier countries are worried about the U.S. having too much control over their reserves. And so you have a diversification into gold. I don't exactly know. I haven't followed it as closely as I used to, but I do think it's a really interesting development. Would also sort of support my view about the dollar weakness, and also I think gold making new highs this year in 20.
Well, in the last couple weeks, the real interest rate has fallen as nominal yields came down, so that might have contributed, as real interest rates are negatively correlated with gold, right? That may have been a factor. But yes, good point. Gold is very strong. Briefly breached new all-time highs this year. As you know, it didn't stay there. Obviously, that was on the back of a geopolitical tension, right? That was the Houthis attacking the U.S. Navy ships, and people were worried about an escalation in the conflict, or was there something else going on?
Well, I mean, I don't think any one event has, I mean, barring something truly cataclysmic, like September 11, has, anything other than momentary impact. I mean, look, gold was very strong before that attack. It's very strong today. So maybe that caused a little bit of a spike, but I mean, that's a short-term trading thing. I think the gold will make new highs in the coming year. And all I'm saying is that, if you went from 0 to 5 and gold was this strong, how strong do you think it's going to be when rates get back down to 3 or 2 or whatever it is? And so I think it bodes well for liquidity-driven assets. I'm also very bullish on NASDAQ. I've been pretty clear about that since Q4 22. I think there's a huge innovation wave that we're experiencing that people just don't, especially older people, have a hard time understanding. The productivity gains, the boom in productivity in the last sort of 5 to 10 years has been unprecedented. So, people say those 7 stocks in the NASDAQ, it's just about that. It's an anomaly. It's a bubble. I don't really agree with that. I think that, probably in 10 years from now, every company in the stock market will be a tech company, really, or, we're sort of moving to that world. So I think it's,
Sorry, what do you mean every company is going to be a tech company?
Well, every company that's going to be successful will have to be using tech in an interesting way. Okay. They're going to be, I mean, bricks and mortar is just, there isn't, the kind of growth, you can't really scale a lot of those types of businesses without being heavily reliant on tech. I mean, look, 20, 30 years ago, I mean, what was it? I saw somebody on Twitter put out an article from the early 80s, on the Microsoft IPO that was, I think it was the state of Massachusetts were barring people from participating in the IPO because they thought it was dangerous. The advent of the internet, you had lots of people saying, "Oh, what's this whole thing? It's kind of crazy." It's the same thing. People, it takes time for them to digest new developments like AI, for instance. I mean, I think all of these things are putting us sort of in a new era. And so I think the stock market, the NASDAQ can continue to run. Gold will make new highs. Rates probably down another few hundred basis points. And then it's very bullish for Bitcoin and Ethereum and some of the companies we invest in the digital asset world.
Yeah, I'm gonna come back to that, the digital asset world. Now, you were saying that liquidity might come back in to the markets when the Fed cuts rates next year. So what will happen to the stock market? It's going to continue grinding higher, you said. Well, some people have said it's already kind of frothy at current levels. Do you agree? It's already in pretty much 2023 highs.
Yeah, no, I don't agree. I mean, it's incredible as well how strong the market has been, despite the fact that you had this 5% 2 years an alternative. Large traditional investors, whether they're institutional or just large individual family office type investors, if they can get a 5% on a risk-free T-bill, risk adjusted, that's like, if you think about it, it's kind of like earning 15% in the S&P something like that, you have, I don't know if the number is 6 trillion, 5, 6, $7 trillion just sitting in cash. I think NASDAQ goes up another 10%. You're going to have a panic out of that cash into some of these liquidity driven assets. So it's enticing to sit there and clip a coupon at 5%. Trust me. I mean, I know, but some of these companies are going to have tremendous performance. Even gold is going to, I think next year, going to have a great year. I do see gold as a risk-free asset. It's sort of a cash equivalent. So again, a lot of cash has been built up because people were nervous about things, as you mentioned. And I think all that nervousness is misplaced.
Why would gold and equities move up together?
Well, both,
yeah.
Yeah, I mean, that it happens at times, both as a result of the rates coming down. And so it's not that complicated.
Well, you told me offline that you're more allocated now to assets that are non-traditional. I believe were your words. I was going to ask you how you're allocating your portfolio for the following year. Maybe walk us through your logic here.
Yeah, I mean, it's not anything different than sort of the big shift that I made about 4 or 5 years ago, which is just and I did this interview in the middle of 2019 about this, and actually quite a few other interviews subsequently about the digital asset ecosystem being sort of the new like big macro investment. And you might say, well, what is that? And so digital asset ecosystem is, I think you have 2 core assets, Bitcoin and Ethereum. Then you have a lot of different venture projects, all those other cryptocurrencies. And then you have many different companies in the space doing all sorts of different things. You have companies that are building the infrastructure of this new digital world. You've got blockchain and financial services companies. You've got metaverse, NFT, blockchain gaming, RWA businesses. And what people don't understand, I don't think, is that there are businesses in this space. I mean, we tend to invest generally in companies making $50 million in revenue or more. These are not venture businesses. There's a whole world growing up, sort of outside of the traditional world, where there's tremendous innovation and growth. It's sort of hard if you're a serious investor, individual, institutional. You look back at the past 10 years and you say, okay, what did I miss? Or what, this was how my portfolio was allocated. What do I miss? Bitcoin has been up 200% annualized. Okay. No asset in the history of the world has ever done that. Again, it's with 7 drops of 70% approximately along the way. So, it's not exactly, I would say, for the faint of heart, or, probably for institutions. And what we've done is built a portfolio of 24 different businesses in this digital asset world that are growth stage, so generally 50 million in revenue or more, that give us exposure to all of these new developments. And and I've mentioned some of them. There are many more things going on in this world outside of just the price of Bitcoin and Ethereum. That may not have been the case 10 years ago, maybe not even the case 5 years ago. But let me just give you one fact that maybe surprise some of your listeners, is that in the middle of 2019, when I started this business, there were only 14 companies in the world in this space that had a valuation, private companies, of over $1 billion. Today, there are over 100. Okay. And that's down from 150 at the peak 18 months ago. So just think about that. 100 companies with a valuation of over $1 billion. And even if that's 10% of all the unicorns that exist in the world today, private companies worth over $1 billion. So I don't know why there isn't more focus on the space. I suspect that within, a few years, I'm not going to be really the only guy doing this. But in terms of growth, the growth rates of these companies are really unmatched by the traditional world. And again, playing currencies and bonds for 5 or 10% moves, or 20% expectations of moves, is just not interesting. I mean, from my perspective. So if I were allocated, I just would say this: if I'm a traditional person and I have no exposure, I think you got to have at least 5% of your portfolio in this digital world in one way or another. I would definitely own Bitcoin and Ethereum. I would own a bit of a venture fund, and then I would have a bit of a growth fund. I think if you're more traditional, you definitely should be, as long as you can be, I think NASDAQ stocks, as long as, and I would have, I would actually you could hold a fixed income position here as well. But I think the returns are going to be elsewhere.
So just to clarify, you're more involved in, I guess, companies that build layer twos and smart applications instead of the layer ones themselves?
No, companies that are involved in, when I say building infrastructure, that could be, an exchange like Kraken or Deribit. That could be a node and API infrastructure company like QuickNode. That could be a, NFT conglomerate, metaverse, I would say blockchain gaming conglomerate like Animoca. It can be a whole, there are a whole bunch of different, I would say, sectors and subsectors within this digital asset ecosystem. We don't actually own any cryptocurrency or any tokens or protocols themselves, just because we have institutional investors who legally are not allowed to own them. I'm not saying I wouldn't, but layer ones and layer twos, those are essentially cryptocurrencies, different protocols. They're not businesses themselves.
Would you buy a Bitcoin ETF? Suppose that goes through?
Yeah, I think many traditional people will, and they've been waiting for it. They're not comfortable, I guess, opening up an account on Gemini or Coinbase for whatever reason, and they want to see the Bitcoin position in their stock portfolio. Maybe they get, they're able to leverage it in their stock portfolio, or maybe they just want to see all their assets on one page, right? Traditional guys like to see. But I think there's going to be massive interest. Absolutely.
Well, you wouldn't consider a proxy to Bitcoin, like let's say a Bitcoin miner, or let's say a company like MicroStrategy that holds a lot of Bitcoin?
Yeah, I would. Everyone, especially individual investors, have different risk tolerance, different preferences, different goals for their portfolio. So I just, I think, Saylor, CEO of MicroStrategy, I think he's fantastic. It's a very nice way to have some leverage Bitcoin. He's been absolutely right. I think he's going to be proven to have really been sort of one of the great, it's sort of funny, I'm sure he doesn't think of himself this way, but as like macro investors out there. I do see Bitcoin eventually heading to, 200,000-300,000 plus, sort of, over the next 5+ years. So,
sorry, how did you derive that number?
Well, I really don't think it's difficult for Bitcoin to be like let's call it a $5 trillion asset. Gold is, I think, 12 or 13 trillion. All financial assets out there, total assets, I think, is 500, 600, 700 trillion. So, could Bitcoin be, some small percent of the total dollar value of all the assets in the world out there? Sure. And so right now I think it's 800 billion or 800 billion. It's definitely an established asset. It's achieved network effect. It's been around for, I don't know, so almost 15 years. And I would say the same for Ethereum. Ethereum has been around now for 8 years. They have very strong network effect established. I just think that you're going to see massive flow in from areas where there's been tremendous hesitancy, especially in the US. Remember this, 85% of total world cryptocurrency trading volume is done outside of the US. This is not a US asset. And so I think that it's inevitable that US institutions and other investors come in and allocate 3%, 5% of their portfolio to assets in this space.
One could argue, though, given how Bitcoin has been performing, it's just a leverage play on the NASDAQ. So if I were an institutional investor and let's suppose I have no experience or little experience in the digital asset realm, I would just look at the price history and say, why don't I just buy a levered ETF on the NASDAQ? Wouldn't that be the same thing?
No, because if you look at the performance of Bitcoin, let's say going back to its beginning, or even start, forget about, late 08, early 09, even start looking at its performance from 2010, 2011, the NASDAQ has actually gone down 99% against Bitcoin. So think about that. There's no asset in the world essentially that hasn't gone down 99%, right? Because Bitcoin's return, if you look at it 200% annualized, right, since its inception, it's destroyed absolutely every single other asset in existence. And I would say Ethereum has done the exact same thing since its founding in 2015. So I don't think it's that. I think, for instance, I think the next 5 to 7 years, I could easily see the NASDAQ doubling in price from here. If the NASDAQ doubles from here, I think Bitcoin will be up 10 to 20 times from where it is today. I mean, 10 times would be 400,000, but it could potentially be much higher.
Right, but that's the point I was trying to make, Dan, is that it just seems to be a high beta play on tech stocks. If the NASDAQ moves up, 200%, Bitcoin's going to go up 10, 20x. So couldn't I just recreate that result by, creating a margin account and trading the NASDAQ on margin, for example, or buying levered ETFs on the NASDAQ? Wouldn't that fundamentally be the same idea here?
The reason, not really, because if if you're levered on NASDAQ and NASDAQ goes down 30% every other year, right? If you're levered, you're wiped out. So no, that's not a good idea. If you go 5 times levered and it goes down 30%, you're done, right? I mean, if you're 3 times levered, you're done. So no, I don't think it's the same bet. Yeah, no, I don't at all. I think they're connected because blockchain technology that underpins Bitcoin, the code, I mean, obviously it's technology, so there's some link, right? It's not, I mean, tech stocks that do other things in the tech world, maybe it gives you more of a diversified type of exposure than NASDAQ to developments in the tech world. But listen, I think that the total addressable market, the TAM, for this digital asset ecosystem is enormous. It's hundreds of trillions of dollars. What do I mean by that? I think everything of value that exists in the world, everything you own, probably within 10 years, will sit on a blockchain and reside in this digital asset ecosystem. So I think everything will eventually be tokenized. And as far as I can see, it's really the digitization of money and value. The the internet, as an example, was just sort of the digitization of information, and maybe ideas and words, not really ideas and information. But this is the digitization of value and money. I mean, that's going to be worth tens, if not hundreds of trillions of dollars. So there's some linkage, but the risk reward, I think, in the digital world is much greater.
Final question, Dan. I'll let you go. Great talk.
Sure.
Argentina just elected a new president, Javier Milei, who was originally a proponent of dollarization. It doesn't look like they're going that route just yet. I think they've kind of turned a 180 for now. But my point is, Dan, they've adopted, where they wanted to adopt this policy where they wanted to give up their peso in exchange for the dollar. Now, in theory, it could be any other currency that the citizens want. It could be the euro, it could be the yuan, whatever it could be. The case may be. In theory, could you see a nation in the future that could adopt Bitcoinization, which is to say that they would abandon the local currency and just use the Bitcoin as a reserve currency and as a medium of exchange for everybody?
Yeah. I think that started to happen already in El Salvador. So you should look at the detail around that. I think it's already started to happen in El Salvador. I think that, in Argentina, already tremendous number of people own cryptocurrency of one sort or another. As their currency has gone down massively in the last 5 years, I think people, and this is sort of documented, and own not just Bitcoin and Ethereum, almost any cryptocurrency in the top 10 has outperformed the RG peso. So I think that, I think this president is a supporter of Bitcoin. I think, look, amongst the fiat currencies, the dollar is always going to be preeminent. I don't see the dollar. It can have a bear phase, go down 10, 20%, but it's, its supremacy sort of amongst all the other fiat currencies, that's not changing. But remember, the dollar has also gone down 99% against Bitcoin in the last 10 years, right? If you had taken all your dollar savings 10 years ago and put them into Bitcoin, let me tell you, your life would be a lot different today than 10 years ago. I'm not saying the same return profile is going to be mimicked, but I do think that your purchasing power of your dollars or your Canadian dollars is really hard to hold up against a Bitcoin or ETH position.
Dan, great talk. Well, appreciate your time. Where can we learn more about your work and your writings? And you mentioned you have a Twitter, an X.
Yeah,
account,
Twitter
right?
is DTapCap. And of course, you can go to the website, 1rtfund.com and 10tfund.com, those two funds. I think I'm also on LinkedIn.
Okay.
So that's enough.
I'll put the link in the description down below. Dan, it was great meeting you. Thanks for being on the show. I look forward to working
My
with you again
pleasure.
in the new year. Happy holidays.
Good luck.
Thank you, Dan. Take care.
Thank you.
Bye-bye.